Imagine owning a tiny piece of Apple. Or, getting paid every time McDonald's sells a burger. That's what happens when you own stocks. Tiny slices of some of the biggest companies in the world. But how does it actually work? And really, why do people risk their money on stocks? At its core, a stock is just ownership, a share in a company. If a company wants to grow, like build new stores, invent new products, or go global, they need more money. Instead of just borrowing from the bank, they go public and sell pieces of themselves to investors. You, me, anyone. Imagine you and 3 friends own a pizza shop. You each own 25%. You want to open a second shop, but don't have enough cash. So you sell 10% of your business to your neighbor for $1,000. Now your neighbor owns a slice of your pizza shop, and if you make more money, their piece is worth more too. That's a stock. But instead of pizza shops, we're talking Apple, Amazon, and Tesla. Stock price goes up. If a company does well, more people want the stock, the price rises, and you can sell for a profit. Dividends. Some companies pay out part of their profits to shareholders, called dividends. Think of it as getting a slice of the profits just for owning the stock. Why do stock prices change? Well, it's a mix of news, rumors, and how a company is actually doing. It's all about supply and demand. If more people want to buy, the price goes up. Big events can shake things up too, like say, a new iPhone comes out, the stock might go up. But if there's a CEO scandal, it might go down. And honestly, sometimes stocks move for reasons that make no sense at all. Like when a tweet sends prices soaring or crashing. The stock market is basically just a giant marketplace. Kind of like eBay, but for stocks. The New York Stock Exchange and NASDAQ are the main stores where stocks are bought and sold, and this all happens every weekday. So, what happens when you buy a stock? First, you open a brokerage account like with Robinhood, E*TRADE or something similar. Then you search for a company and buy shares, even as little as $1 if you use fractional shares. You can sell whenever you want, or just hold on to your shares forever if that's your thing. Stocks go up and down. There's no guarantee you'll make money. Sometimes companies just fail. Rule number 1, never invest money you can't afford to lose. But over the long term, the stock market has actually made more people rich than any casino or lottery ever could. Wild true story: Amazon's $1 million pizza guy. If you'd bought $1,000 of Amazon stock back in 1997 and just held on to it, you'd have over $1 million today. But honestly, most people panic and sell way too soon. Or, well, they never invest at all. So, how do you actually get started? Here are the basic steps. First, open a brokerage account. Even on your phone, it's super easy these days. Next, learn about companies you like. Look for strong brands and steady profits. Start with small amounts, $10, $50, whatever you can afford. And really, the key is to invest regularly. Even $20 a month adds up over time. Let's talk about some myths versus reality. Myth number 1, you have to be rich to invest. That's just not true. Myth number 2, the stock market is just gambling. It's not if you're patient. And myth number 3, you need to pick the next Apple to win. Actually, most people build wealth slowly over time. So, the next time you hear the word stocks, just remember, you're buying a real piece of real companies. And over time, those little slices can turn into some serious wealth. Want more easy finance tips, wild investing stories, and beginner guides? Go ahead and subscribe, and let me know your biggest question about money in the comments.